you're over 55 and you're thinking about a move, you're probably thinking about financing, right? And one of the concerns you have is, oh my, what should I do, particularly in this interest rate world that's a little bit higher? We have advice for you, and that is you have to think about retirement. You got to. You got to think about retirement. The reason why I say that is the decision that you make might actually sabotage everything you worked for seriously, really hard for a long time, for 40 plus years. So we don't want that to cost you. So I want to share with you a strategy that my preferred lender, Pete Griffin with Movement Mortgage, shares with me when I asked him this one question. I said, Pete, how would you help someone who's over the age of 55 think through how the current interest rates are actually affecting them if they moved? So first, he said, you have to have a reality check. All right, have a reality check that nobody talks about. He said, the reality is life expectancy in America is pushing 80 years old, with many people living into their 90s or even beyond. But here's the kicker, though. The average homeowner stays in their houses 6 to 11 years before moving again. So if you're 60 right now, do the math. You're likely going to live for another 20 or 30 years. And that means this probably isn't your last home. I know you really want it to be. I've helped many people buy and they think it's their last home, and then stuff happens 10 years later, they're moving again. So don't finance the house like it's your last. That's the key. Because here's the conventional wisdom trap. Actually, most people at 60 think, I'll buy down my interest rate, I'll lock in a low payment, and ride this puppy out for 30 years. Wow, guys, it's not actually the wisest decision often, and it could be a more expensive decision because you're paying thousands of points, right, in fees to buy down your rate that's probably going to drop anyways in the next few years. So you're locking yourself into a long-term loan that you might not even keep that loan for a decade. Okay, that's just the reality. So here's Pete's recommended strategy. He says, rule 1, don't overpay for your rate. Right now, don't do it. Rates are forecasted to come down. Don't go dump $10,000, $15,000 or whatever it is into points trying to buy down your interest rate. Keep your origination fees, your points all below 1% of your loan amount, right? Because when rates do drop, 18 months, 2 years, right, you're going to refinance anyways. And all that money that you spent is gone. Bye-bye. All right. Rule 2, think short term, not long term. It's so hard, but this is his recommendation to protect your finances. Think short term, not long term. So what do we mean? If you have financial means and you have the ability with your income right now, you're still working, well, actually consider a 25% down payment and take a 15-year fixed mortgage instead of a 30. I know what you're thinking. I know it. You're saying, Sean, my payments are going to be too high. Well, yeah, they're high, but here's what happens. By the time you're 70 years old, you either own your home outright or you have massive equity. You're talking hundreds of thousands of dollars. So if this is your forever home, well, now you're living payment free in your 70s and 80s. If this is not your forever home, well, awesome. You got serious equity to leverage into your next move. Rule 3, when you refinance, keep the term. So let's say rates do drop and you refinance in 2 years. Don't reset the clock on another 15 years. No, just refinance the rate, keep your remaining term, stay on track to own it by 70. Now, rule 4 is your equity. Your equity actually becomes retirement assets. This is the secret weapon nobody talks about. If you've built all this equity and you need access to this cash when you're in the 70s and 80s, well, maybe for healthcare, right? Enjoying retirement, maybe to help your kids. You tap into this through home equity conversion mortgage, also called a reverse mortgage. It's not a bad word anymore. It used to be. Now, you're not forced to do this, but you have the option actually. And that's super powerful. And it gives you financial flexibility. So I just think this matters, y'all. Here's what I think this strategy that I just laid out does. It doesn't trap you into 30 years of payments, hoping this is your last move. It builds wealth and equity fast, whether you stay or go, okay? It gives you options and it treats your home like, well, what it's supposed to be. It's an asset. It's a financial asset. It's a major financial asset that should be working for you and not against you. So most people at 60 think they're too old to be strategic. I'm telling you, this is when strategy matters most. So look, everything we do, if you can think about the possibility about putting 25% down and do a 15-year mortgage, guys, do it. But if you can't, that's okay. All right. But this principle actually still applies regardless. Don't overpay for your rates. Don't overpay for rate buy downs. Interest rates are going to drop. Okay. Keep your financing flexible. Think about your home as a 10 to 20 year asset, not a forever decision. So if you're only 60 and thinking about your next move, you deserve more than a cookie cutter advice. Okay. So you deserve strategy built around your life, built around your retirement, built around your goals. That's what we do at 1245 Team. We want to really kind of just marry this real estate expertise with real world retirement planning. So we want to serve you, we want to talk with you, we want to help you. Message us. Let's connect.